Imagine waking up, grabbing your phone, checking your portfolio, and discovering that a supposedly safe asset, one that was literally designed to stay at exactly $1, is suddenly worth almost nothing. Well, in May 2022, that wasn't just a bad dream for thousands of investors. It was reality. Welcome to this explainer on the total collapse of Terra, its tokens UST and Luna, and how one of the absolute most celebrated projects in finance totally unraveled in just a matter of days.
$40 billion. Just let that sink in for a second. We're not talking about some tiny, obscure crypto project cooked up in a basement. Terra was this massive, sprawling ecosystem that was supposedly backing the very future of decentralized finance. It attracted major venture capital and legions of everyday believers, and then, in a blink, gone. But to really do a proper autopsy on this, we need to be super precise about what that $40 billion actually represents.
When we say $40 billion was wiped out, we're talking about market value. We're not talking about $40 billion of physical, hard cash suddenly missing from a bank vault somewhere. It's the total perceived market capitalization of the asset that just evaporated. You see, when confidence vanished, the perceived value of the entire ecosystem vanished right along with it. To see exactly how that confidence was built and ultimately how it was destroyed, we've got to rewind the clock a bit.
Part 1. The Mechanism and the Promise.
So, to understand this collapse, we first need to look at the masterminds behind the project, Terraform Labs, founded by Do Kwon and Daniel Shin. They created two main tokens, TerraUSD, which we'll call UST, and Luna. UST was marketed as a stablecoin, meaning one UST was supposed to always be worth exactly $1, no matter how crazy the rest of the crypto market got. But here's the catch. A traditional stablecoin is usually backed by actual dollars sitting safely in a real bank vault. UST was not. It was an algorithmic stablecoin. Its stability relied entirely on this highly complex mathematical relationship with its sister token, Luna. Think of this algorithm kind of like a giant financial teeter-totter, and it's designed to keep UST perfectly balanced at exactly $1. If demand pushed UST above $1, the system let you create more UST and remove Luna from circulation, which would bring the price back down. On the flip side, if UST dropped below $1, it encouraged the exact opposite. You could create more Luna and remove UST, reducing the supply to push the price back up to $1, right? On paper, it was an incredibly elegant mechanism. But as we're going to see, financial systems don't just run on paper. They run on incentives, and above all else, they run on confidence.
Part 2. The 20% Catalyst. This was the intoxicating element that basically poured absolute rocket fuel all over the Terra ecosystem's fire. This number, 20%, is staggering when you think about the context. Terra introduced something called the Anchor Protocol. Basically, if you deposited your supposedly stable, dollar-pegged UST into Anchor, you were advertised yields as high as roughly 20%. Now take a second and think about what that actually means. A stablecoin is supposed to behave like boring old cash. Yet users were being offered returns dramatically higher than anything you would normally associate with holding dollars. I mean, it was an irresistible magnet for money.
And that 20% yield, it triggered a massive market-wide feedback loop. Now, Wall Street and institutional players weren't literally tricked by some cheap sleight of hand. Rather, retail investors, VC firms, institutions, they all bought into a collective, really powerful narrative. Success creates credibility, right? That credibility attracts serious capital. That capital pushes prices higher, which in turn creates even more credibility. By early 2022, Terra was arguably one of the most talked about projects on the planet. But this exposes a super dangerous psychological trap. Explosive growth can entirely hide fatal underlying weaknesses. When a system relies entirely on belief and the technology is extremely complex, average investors, and honestly even the professionals, often mistake that complexity for safety. They stop asking where the 20% yield is actually coming from. They just assume someone smarter has already checked the risks. They stop asking what could make it fail, and they only care about how high it can go.
Actually, scratch that. The cracks were there way before the final collapse. Back in 2021, Terra experienced a major warning sign. UST temporarily lost its $1 peg. According to later SEC findings, a massive trading firm actually had to step in and purchase over $20 million worth of UST just to help push the price back to $1. The system was vulnerable. The algorithm was tested, and it had cracks. But the explosive growth just totally masked it. The ecosystem kept exploding in early 2022, and confidence remained sky-high. That is, until May 2022.
Part 3. The Death Spiral.
This is the climax of our explainer, the exact moment the algorithm broke. In early May 2022, USD began slipping from its $1 peg again, but this time confidence evaporated, exposing a horrific, fatal flaw in the design. Remember that teeter-totter? As people panicked and sold their UST, the system automatically created more Luna to try and restore the peg. But investors were now losing confidence in Luna too. So what do? They sold the newly minted Luna. The algorithm just kept trying to save UST by printing more and more Luna, causing Luna's supply to absolutely explode. The price of Luna crashes, which causes more panic, meaning more people sell USD, which prints even more Luna. The exact mechanism designed to stabilize the system actually accelerated its total destruction.
If that sounds a bit too technical, let's look at it this way. Imagine a traditional bank run where everyone suddenly lines up around the block to demand their money back. Usually, the bank has safe assets they can sell to give people their cash. Now imagine a bank run where the very asset the bank is relying on to pay you back is crashing in value at the exact same time. The worse the asset performs, the harder it is to restore confidence. Panic, it turns out, moves way faster than any algorithm ever could.
And the result was absolutely brutal. The Terra ecosystem went from a peak value of roughly $40 billion to near zero in a matter of days. Luna, which was once one of the most valuable cryptocurrencies in the entire world, traded at a microscopic fraction of a penny. I want to pause here for a second because it is absolutely vital to remember that behind these vanishing numbers were real people, real investors who believed they were holding something stable, or who truly believed they were a part of the future of finance. When confidence disappeared, the market value followed right out the door.
Part 4. The legal aftershock.
Because look, the story definitely doesn't end with the token crash. The financial collapse forced the entire business model into a corner. After the May 2022 implosion, authorities stepped in. Fast forward to 2023, the SEC officially charges Terraform Labs and Do Kwon with fraud, alleging they actively misled investors about the stability of UST. By April 2024, a U.S. jury finds Terraform Labs and Kwon liable for fraud. And finally, in June 2024, the SEC announces a massive settlement exceeding $4.5 billion, pushing Terraform toward winding down its operations in bankruptcy. The financial collapse practically guaranteed a legal one.
Part 5. Lessons for every investor.
So what do we actually do with all this information? Because this isn't just a story about crypto. These 3 takeaways are universal. First, never ever confuse a promise with a guarantee. Just because a coin is designed to stay at $1 does not mean it is physically impossible for the price to fall. Second, high returns always demand hard questions. If you are offered unusually high yields on a supposedly stable asset, you must be able to explain exactly where that yield comes from and who absorbs the losses. And third, complexity absolutely does not equal safety. If you don't fully understand the underlying mechanics of an investment during a crisis, you simply don't understand the investment. Period.
And that brings us to the absolute core psychological lesson of the Terra collapse. The biggest risk in investing isn't always wild price volatility. Sometimes the most dangerous thing you can do is start believing that a system is just too big, too smart, or too popular to fail. Because the moment an entire market believes a system is completely safe, they stop preparing for disaster. They stop hedging their bets.
So the $40 billion lesson from Terra isn't just about questioning new technology. It's about questioning human nature. When everyone around you is totally blinded by massive yields and intoxicating narratives, the most powerful question you can ask in finance isn't, how much can I make? The real question, the one that actually protects you when the algorithms break and the confidence completely vanishes, is simply this: what happens if I'm wrong? Keep that question with you every single time you invest. Thanks so much for joining me on this explainer, and I'll catch you next time.